Hi everyone, my name is Jatin Patni and in this short video presentation, I'm going to walk you through a new portfolio optimization technique called GOPALS, which stands for Geospatial Optimization and Portfolio Allocation using Landscape Segmentation. You can go through the associated research paper submitted to SSRN at the URL highlighted here. You can also look at the source codes, datasets, and results in the GitHub repository that we have created to support ongoing research with GOPALS. Feel free to reach out to me via email or LinkedIn using my contact details listed here. We're going to cover the following areas. We'll start with the importance of portfolio optimization. Then we'll give some background and the limitations of traditional portfolio optimization techniques. Then we are going to introduce the GOPALS methodology and how it works in detail, the experimental setup within a specific universe, its results, and its contribution to the field of portfolio optimization. Portfolio optimization is a very crucial concept in finance. It focuses on choosing the best mix of assets to maximize the performance. Think of it like crafting a perfect recipe. How to combine stocks, bonds, funds to achieve a goal, say maximizing the Sharpe ratio. Sharpe ratio measures the risk versus return trade-off. So why is this important? It ensures a risk-return balance. It ensures diversification, spreading investments across different assets, and it ensures efficient asset allocation so that the capital works smarter. Institutional investors like hedge funds and pension funds use it to meet their financial targets. Wealth managers use it to guide their clients towards their goals. Quant traders apply these advanced models to optimize portfolios in real time. The foundation of portfolio optimization lies in Harry Markowitz's 1952 Mean-Variance Optimization framework. It was a groundbreaking concept that highlighted the importance of diversification and the trade-off between risk and return. But over time, researchers identified key limitations in the framework, most notably its sensitivity to the estimation errors in expected returns and covariances. These errors often lead to extreme portfolio weights and instability, making the framework less reliable in real-world markets. To address these challenges, researchers have explored three key areas. First, dealing with the estimation errors using techniques like Leibowitz and Wolff's shrinkage methods and Michaud's resampling techniques to stabilize the portfolio weights. Then, alternative risk measures such as value at risk, conditional VAR, and other downside risk measures, which better align with the fat tail distributions and investor preferences. And the third area is robust optimization by incorporating uncertainty directly into the optimization process, making the results more resilient to the estimation inaccuracies. Despite these advancements, gaps persists. The traditional framework struggles with the three major limitations. It remains highly sensitive to input errors, leading to suboptimal outcomes. This chart highlights an important challenge in portfolio optimization. How small changes in the estimates can drastically affect the portfolio composition. At the center, you see an efficient frontier where the red dot marks the portfolio that delivers highest return for each unit of risk. This is known as the max Sharpe ratio portfolio. Now observe the animation closely. As small perturbations of just 1% are introduced to the expected return or risk estimates for individual stocks, the portfolio allocations change dramatically. For instance, stock 8 and 10 show large fluctuations in their weight, while stocks 4 and 6 occasionally drop to near zero allocations. This happens because traditional portfolio optimization depends heavily on precise estimates. But in the real markets, our estimates like future returns or risks are rarely perfect. These small errors can lead to unstable portfolio weights, leading to frequent rebalancing, which can increase costs, over-reliance on certain stocks, making the portfolio concentrated and risky. This is why we need robust frameworks like GOPALS. We'll see later that by focusing on regions where portfolio performs consistently well, even when the inputs are uncertain, GOPALS reduces this instability and helps create practical, reliable portfolios for real-world investing. Traditional optimization techniques also lack a visualization in the higher dimensions, making it difficult to interpret or intuitively explain the choice of optimal portfolios. They also assume static market conditions and fail to adapt to changing dynamics. This is where we introduce GOPALS, Geospatial Optimization and Portfolio Allocation using Landscape Segmentation. By simulating diverse market scenarios and clustering portfolios in the high-dimensional weight space, GOPALS identifies stable regions, areas where portfolio allocations consistently perform well, regardless of the estimation errors or market fluctuations. Unlike traditional portfolio optimization methods, where the portfolios sit precisely on the efficient frontier, GOPALS prioritizes robustness and practical consistency over theoretical perfection. The backtests demonstrate that portfolios selected from these stable regions outperform during the booming markets and maintain resilience across volatile regimes. In essence, while Markowitz laid the foundation for portfolio optimization, GOPALS redefines the boundaries of portfolio optimization, offering investors a resilient, data-driven framework that adapts to uncertainty and dynamic market conditions. We start by narrowing down the universe of assets. For our study, we focused on the Indian equity mutual funds, filtered by criteria like volatility and historical availability. We saw that many of these mutual funds were highly correlated. So we use hierarchical clustering to reduce the redundancy by selecting representative funds based on their correlations. Finally, we arrived at a universe of around 25 mutual funds. Using historical data as a foundation, we generate thousands of future market scenarios through Monte Carlo simulations and bootstrapping. These scenarios incorporate variations in returns, volatilities, and correlations, mimicking real-world uncertainty and market dynamics. For each simulated scenario, we generate random portfolio weight allocations constrained to realistic conditions like long-only positions and fixed portfolio sizes. Risk and return metrics for these allocations are recorded across all scenarios. The key innovation lies in the clustering of portfolios based on their consistency in performance. We apply k-means clustering to identify groups of portfolio allocations that frequently achieve top-tier performance, measured using metrics like Sharpe ratios across the scenarios. To visualize these stable regions, we projected high-dimensional portfolio weight space onto 2 dimensions using TSNE algorithm. As you can clearly see the clustering behavior in the high-dimensional space, we call these regions as stable regions. From the identified stable regions, we selected portfolios that not only met performance criteria, but also exhibited robustness and stability across market regimes. These portfolios lie slightly below the traditional efficient frontier, but outperform in terms of stability and real-world adaptability. This is unlike the mean variance optimization portfolios that lie on the efficient frontier, but are very sensitive to the estimation errors. We backtested a strategy based on GOPAL's portfolio selection across multiple out-of-sample periods, including flat, boom, and recessionary regimes. We used previous 3 years market scenario data to identify stable regions using GOPALS and chose a portfolio from these stable regions to be held for the next 1 year. By using historical and simulated market scenarios, GOPALS identified portfolios in the stable regions that delivered favorable risk-return characteristics. Portfolios from these regions demonstrated resilience to estimation errors and outperformed traditional strategies like mean variance optimization and other market benchmarks in terms of stability and Sharpe ratios. We are excited to report our findings, which show that for our choice of universe and portfolio size, GOPAL's approach is able to find stable regions that perform consistently across multiple market regimes. We saw that during boom periods, GOPAL's portfolio outperformed all other, especially mean variance optimization portfolios significantly, offering around 20% better Sharpe ratios, while in the flat or recessionary markets, its performance remained competitive with slightly higher returns but slightly lower Sharpe ratios than the mean variance optimization, while performing better than the market benchmarks and the equal weighted portfolios across all market regimes. An important observation is that while GOPAL's portfolios often lie below the efficient frontier, they deliver the much needed stability and resilience, which is critical in uncertain markets. This reinforces GOPAL's ability to address estimation errors, making it a practical and robust alternative to traditional approaches. We were able to show that GOPALS addresses the limitations of traditional mean variance optimization techniques, especially in the face of uncertain future estimates. It offers a more resilient approach to portfolio construction, leading to better investment outcomes in volatile and uncertain markets. By identifying the stable regions via segmentation of the portfolio weight space, GOPALS offers investors a visual tool and an explanation for the choice of the optimal portfolio. This research has focused on a very narrow scope of Indian equity mutual funds and a very small portfolio size because of compute availability. As next steps, this should be tested on different global equity and debt markets with bigger portfolio size depending on the compute availability. Another area could be to generate the future market scenarios using machine learning techniques like GANs. GAN stands for Generative Adversarial Networks. This could further improve the robustness of the portfolios. Feel free to reach out to me. Feel free to reach out to me if you want to know more about GOPALS or collaborate on researching the effectiveness of GOPALS in a specific market. Thank you.